CRA Explained: How Canada Actually Calculates Your Taxes. Educational disclaimer: this video is for educational purposes only. It is not financial or tax advice. Always confirm details based on your personal situation. Most people in Canada don't actually understand how their taxes are calculated, and that misunderstanding costs them money every single year. If you've ever wondered why your tax refund is smaller than you expected, or why you feel like you pay too much tax, this video will make everything clear. Today, I'm going to explain how Canada actually calculates your taxes, step by step, in plain language. In Canada, taxes are calculated by the Canada Revenue Agency, also known as the CRA. The CRA does not guess your tax. It follows a fixed process. And once you understand that process, taxes become predictable instead of confusing. Everything starts with your total income. This includes employment income, self-employment income, interest and dividends, rental income, and some foreign income. Before any deductions, the CRA looks at everything you earn during the year. Next comes net income. This is your total income minus certain deductions. Common deductions include RRSP contributions, childcare expenses, union or professional dues. Net income is important because many government benefits and credits are based on this number. After that, the CRA calculates your taxable income. This is the amount that will actually be taxed. Not all income is treated the same way, but everything flows through this step before tax is calculated. Canada uses something called a marginal tax system. This is one of the most misunderstood parts of the tax system. A marginal tax system means you do not pay one single tax rate on all your income. Different portions of your income are taxed at different rates. For example, if you earn $60,000, only the top portion of that income is taxed at the higher rate, not the entire $60,000. This misunderstanding alone causes a lot of unnecessary stress. Another important point is that you actually pay two types of tax: federal tax and provincial tax. The CRA calculates both, then combines them into one total tax amount. After calculating tax, the CRA applies non-refundable tax credits. These credits do not give you cash, but they reduce the amount of tax you owe. Common examples include the basic personal amount, tuition credits, the Canada employment amount. Many people don't realize how much these credits reduce their tax bill. Finally, the CRA compares how much tax you owe with how much tax you already paid during the year through payroll deductions. If you paid more than required, you get a refund. If you paid less, you owe the difference. A tax refund is not free money. It's simply your own money being returned to you. A very common mistake is believing that a large refund means you paid less tax. In reality, it often means you overpaid during the year. The goal isn't a big refund. The goal is paying the right amount of tax. Let's quickly summarize how the CRA calculates your tax. First, total income. Then, net income. Then, taxable income. Apply tax rates. Subtract credits. Compare with tax already paid. Once you understand this flow, taxes stop being confusing. If you want clear, simple explanations about money in Canada, including taxes, investing, and dividends, subscribe to Maple Money Playbook. That's exactly what we do